Let's quickly look at some strategies. So there's cash flow, which is the movement of cash in and out of a business over a period of time. If more money goes out than comes in, or if more money must be paid out before cash payments have been received, there's cash flow problems. So you really want to make sure that it's balanced. It means that you're keeping cash readily available in the business by using cash flow statements, speeding up payments by debtors, and delaying payments of suppliers. So you can have inflows, and your inflows are coming from your sales, from your accounts receivables, from commissions, dividends, rent, and interest. Outflows is all the money coming out, which is payments to suppliers, interest on loans, operating expenses, drawings, purchase of assets, and loan repayments. So the first strategy is cash flow statements, which I think is pretty good to talk about as a strategy because you guys would have done that in year 11. So for the cash flow statement, it's a financial statement that indicates the movement of cash receipts and cash payments resulting from financial transactions over a period of time. It's a continuous rolling cash budget. It shows patterns of short-term management of cash inflow and outflow. It can help you identify trends and act as a predictor of change, but it also indicates the movement of cash receipts and payments resulting from transactions over a period of time. So you can see like, oh, in June, we actually have a lot of outflow. Maybe we should distribute our payments throughout the month, or we should turn into throughout the year, or start paying this fee quarterly so we don't have this massive outflow all in one month. And a lot of the times companies, because June is end of financial year, a lot of their bills will be due then, and they'll have massive outflows, while they can then apply that strategy of distribution of payment to help that. This is a question from the 2016 HSC. So it's got the table shows cash flow information for a business. What is the opening balance for April? This is direct calculator question where you're just going to pump in those numbers. And when you pump them in, this one's a bit frustrating because you have to go through all of them to get to April, which is at the end. But when you pump them in, you'd get to a negative 24,000. I just wanted to put this in so if you guys come back to these slides later on, you can figure it out. But if you do have your calculator or your phone nearby, you can definitely have a go at finding out that cash flow. This is purely just numbers and doing the difference from the opening, adding on that in, and then minusing the out to see what you're left with, and then starting all over again. Now, management strategy 1 is distribution of payments, which is distributing payments throughout the month, year, or other periods so that cash shortfalls don't occur. You don't want all your large expenses due at the same time. So yearly distributions mean that there's equal cash flow each month rather than large outflows in certain months. And this allows the business to have cash flow projection to identify periods of shortfalls and surpluses, and then better adequately just distribute and organize their money. Number 2 is discounts for early payments. I really recommend feeling confident with this only because it comes up across quite a few of the ratios, especially the accounts receivable turnover ratio. So it's most effective when it's targeted at creditors who owe large amounts in a financial year. It basically means that as the creditor, you will pay me now instead of when the money is due for 2 months. So maybe I own a kitchen business and I build your kitchen and I'm like, okay, pay me back in 2 months. But 1 month later, 1 month in, I'm like, you know what? I want to hire a new worker. I want to buy a new car. Instead of going to debt, I already have this money that you owe me, but I don't want to wait another month. I need this car now. I'm going to go to you and I'll be like, hey, I know the money's due next month, but if you pay me now, I'll give you 5% off. I'll give you 10% off. You get to decide what that discount is. And then you're like, okay, I'll pay you it. I'm getting it cheaper. I'm getting my money. For me, it's great because I can get the money straight away, but at the same time, it's coming at a loss because I've got the discount. It's good though because that discount is something that I decided. The opposite is factoring. Now, factoring gets confusing because a lot of people confuse it with the discount for early payment. It's very similar, but factoring is when a third party is involved. So factoring is when there's a third party business. I go to them and I'm like, hey, I really need this money. Can you chase up this person to get it and give me the money now? The factoring business would be like, okay, let's say I had like 100 grand. I had an accounts receivable of 100 grand. I'm going to go to that company. I'm going to be like, listen, I have this accounts receivable of 100 grand. They're going to be like, okay, depending on the business, it'll either be 70 to 90% that they'll give me. So they can either give me 70K or they can give me 90K. They can keep, let's say for example, it's 90%, like their business policy is 90%. They're like, okay, we'll give you back 90%. So where I get 90K on the spot, they get to keep 10K for what they do. And then they go and chase up that person and wait for that person to fulfill that account. So then I get my money straight away. But again, it's coming at the loss where that company gets a minimum of 10%, the factoring company. But it means that I get my money sooner, and even though it's a bit less, it helps improve my working capital management in the event of like an absolute emergency. But again, discount for early payment means yes, you have to chase it up, and yes, that's timely, but you can decide that discount, while for factoring, it can be 10 to 30% loss that factoring business gets to keep. So you really got to consider, am I willing to lose that money? How desperate am I for money? For profitability, please, expense minimization always, it's just such a go-to, and I feel like it's one of the easiest ones to use. So it's just reducing expenses wherever possible. Expense budgets are really helpful because they'll show you where expense patterns are invisible, where are visible, and then you can eliminate waste and reduce that unnecessary spending so that you're increasing your productivity and efficiency and then still achieving profit maximization. That can be through casualization of the workforce, outsourcing, bundle pricing, downsizing or relocating operations, and finding cheaper suppliers. Now we're going to finish off with global strategies. Sorry, I'm like running through, but I want to make sure that we get all of this done. Again, all of this is going to be in the downloadable slides. Like, you can download all these slides to come back to this. This is recorded as well to come back to. I'm 100% going to make TikToks on this, so if you guys are on TikTok, follow up. But otherwise, any questions about any of this, I hope you guys are asking. I really hope I'm not just sitting in the live chat like waiting for questions. I hope we're having a chat. My goal, like, I'm recording this in advance and this is going to be premiered, but my goal is that we're having some fun on the chat. We're all becoming besties and we're getting through all this content. Exchange rates are the value of one country's currency in terms of another currency. But again, exchange rates are always fluctuating. Now, if you're an economics student, this is one of the parts where economics and business really overlap. Personally, I was not an economics gal, and the exchange rates and when we deal with other money and the converting wasn't my strong point. But this is how I really understood it. So appreciation is where the upward movement of the Australian dollar goes against another currency, which means it's raising the value of AUD. So one Australian dollar is buying more foreign currency, but one foreign currency is buying less Australian dollars. Now that's great for us when we're buying from overseas and we're importing, but exporting, who's going to want to buy from us when one of their units buys less of our AUD? Like, no one's going to want to buy. So it's great for us and when we're importing, but no one's going to want to buy overseas. Depreciation is the opposite, where the Australian dollar is moving downwards against another currency. So it's lowering the value of AUD. So one foreign currency buys more AUD. So that means that our exports are going up because everyone wants to buy from Australia. They're like, listen, like, look how cheap it is. But for us, we're too scared to buy from overseas because everything's really expensive. So one AUD is purchasing less foreign currency. I always think of, if you guys have gone to like StockX, or you've gone to like buy shoes, or even just online, you know how sometimes naturally when you're doing online shopping, the price doesn't convert, especially from like USD. So like you'll see shoes and you'll be like, oh, $200, that's mad. And like you convert it and it's like $300, $400. And you're like, what's going on here? And even if you've gone overseas, I remember when I went to London, the pound at that time was nearly double. So I saw like this pencil case. I was like, oh, $20, that's mad. And then the pencil case was 40. And I had a student who was telling me like pieces nearly cost like $50 in like USD, like when she was in America at one time. So it's all depending on the dollar. But I think if you've traveled overseas or if you've just done online shopping, it's a really good way for you to just understand how the currency is changing and how that's going to affect you. That's also then affecting the interest rates, because a lot of, like I said before, a lot of businesses are like, oh, cheap interest rates, I'm just going to go to a developing country and borrow from them. But just because the interest rate is lower at that time, if the exchange rate changes, then that interest rate is going to go up as well. So you cannot trust. It is a risk. Methods of international payment is how you can get around that. And these are them in terms of risk for the exporter. So payment in advance, letter of credit, bill of exchange, and clean payment. Let's go through them. Payment in advance, like I said before, like I said with the rainbow and how I had to like dumb down, what was I dumbing down? Global economic outlook. I also had to dumb down payment in advance. The only way that I understand this and that makes sense to me is that payment in advance is like when you go online shopping. When you go online shopping, you pay for it and then you just have to trust that it comes. You got to trust that it gets delivered. You got to trust that it's what you ordered, that it's the quality that you hope for, or that's being like promoted. You just got to trust it. So the exporter receives the payment. The online shopping place is going to get your payment first. And after they've got that payment, then you're getting your confirmation email. Then you're getting your AusPost delivery, we're coming at this time, text, and then you're going to get your good. So the payment exposes the exporter to no risk. And when you're online shopping, Shein and all that aren't at any risk because you've already paid them. They've got their money. You're at all the risk because you've already sent them the money and you haven't even received the goods yet. So it's exactly the same for exporters and importers. Not many importers are agreeing to this method because there's a higher risk because they're sending all this money, especially when it's suppliers and you're buying like hundreds of thousands of dollars of goods. You're putting a lot of trust overseas to some company that there's no guarantee you're going to even get what you ordered on time in the quality that you ordered, etc. So payment in advance is risky for the importer, just like online shopping is risky for us because you don't know that you're going to get it on time, that you're going to get it at all. Some people just never get their item, or that you're going to get what you asked for and what you paid for. But for the exporter, it's great because they get all their money. Doesn't matter how you feel, they got their cash, they're on the way. So if you're struggling with some of these, I feel like applying them and putting them in terms that fit your understanding. And for me, it had to be online shopping. I am consistently shopping. That's what worked for me. Now, letter of credit is where the document, a buyer requests it from their bank that guarantees the payment of good will be transferred to the letter once they've to the seller, and once they've committed to that, the buyer can't withdraw. So what that is, if I was going to buy, let's say I wanted to buy 100K worth of clothes for my clothing company, because apparently I want to keep using the clothing company example. If I wanted to buy 100K worth of clothes from a supplier in Singapore, I would go to Commonwealth Bank and I'd be like, hey, I want to buy this amount of clothes from Singapore. Can you sign this letter of credit and help me out with this? So Commonwealth will then sign that letter, and they're going to send it to the exporter, and that letter promises that at a specific time they're going to pay them once certain conditions are met. So those conditions might be as soon as we've gotten confirmation that the goods have left the country, as soon as we've gotten confirmation that the clothes have like entered Australia. There can be all different conditions. It really just depends on what that letter is, but the bank has signed that. So what that means that if the buyer fails to make the payment, the bank has to cover the purchase. So if a month later I'm like, you know what, I actually found a cheap supplier, I'm not doing this. First of all, the bank is forced to pay it. So no matter what, the exporter is going to get their money. But then you know what banks are like. Banks aren't just going to let you decide and like pull out of something that you've legally signed. That's like a legal document now. The bank is going to come chase you up and you have to cover that purchase. So the issue with letter of credit for buyers is that as soon as you sign that letter, you're stuck. Like you are stuck and like sucked into this deal. It's popular with exporters though, because they rely on overseas banks rather than the importer. From that Singapore company, they don't have to rely on some random 19-year-old who wants to buy 100K of clothes. They can rely on one of Australia's biggest banks who have signed it and agreed to it. So it is popular for them and it's less riskier for the exporter. But for me as a buyer, it is risky because I'm stuck in that deal. It's less risky, however, than the payment in advance because at least some conditions can be met. Clean payment is online shopping to a T. This is the difference. So payment, is the opposite of online shopping. So payment in advance is online shopping. Clean payment reminds me of when we normally go to the shops. So when you normally go to the shops, you get the good, you get to try it on, you grab it, and then you pay for it. Same when you get like a service done. So if you get your nails done, you go get a haircut, that you get that service done and then you're paying for it after. And this is exactly like clean payments. So for clean payment, the exporter, so that company from Singapore is sending me my clothes first and then they get their payment. So I'm getting my clothes first and then I'm going to send them the payment. So the importer, so I'm not going to pay them until I receive my goods. And on top of that, the exporter is requesting an invoice and they're going to give me 30, 60 or 90 days to pay that back. That's really great for me because I get my product first. I get to make sure it gets here on time and it's the order that I ordered, and then I'm secure with it. And I'm like, okay, I'll pay for it. Just like when I go shopping or when I go get my hair done, I get my hair done first, I get to see the result, and then I'm like, okay, all good, I'll pay you. That's different with online shopping where you have to just trust the good before it gets here. So it's advantageous for the importer, but it's only going to be used by the exporter if the exporter is confident that the importer is going to pay. So it's got a lot of trust with you got to have trust in the importer, because as an exporter from that company for Singapore, for example, they have to really trust that I'm going to pay that money because they're sending me all their goods. How do you know that I'm going to pay it? And especially because it's overseas and you're dealing with language barriers, financial differences and fluctuations in currency and exchange rates and interest rates. There's so much going on. So chasing up payments is definitely difficult with the barriers of like globalization and distance. So this method isn't too popular among exporters, and it only is going to be popular if they're confident or if it's someone that they supply with often and that they trust. And lastly is a bill of exchange. Now this can either be a document against payment where the exporter demands that the importer can only collect the goods after paying, or that the importer may collect the goods before paying. This bill of exchange is commonly used because the exporter gets to maintain control over the goods until the payment has been made, and it's kind of more on their terms, so it's less riskier for them. But again, if they choose to document against acceptance where I can't get my goods until I pay, the document against payment where I can't get my goods until I pay, that's a risk. While document against acceptance where I may collect them before paying, that's a good one. So it really just depends with everything. Each of them are going to affect the exporter and the importer differently. This is the risk for the exporter, and obviously it's going to be the opposite for the importer. But I hope that makes sense. Please ask questions. I know this is actually really hard. I struggled to sit with this for a while. Like, I had to sit with these notes, and I had to just keep asking my teacher to re-explain again and again for all of global financial management, just because, again, I wasn't doing economics, and my common sense in that area just isn't really switched on. I'm still trying to understand Australian money, Australian math. Can't grab on that. So I think that if you're still finding this difficult after that explanation, that is completely fine. With time, it'll sink in. Definitely ask your teachers about it. Try to talk about it and read it up as much as you can on them, just so it sinks in. But yeah, for me, understanding that payment in advance and clean payment were just like online shopping in comparison to real shopping. Those real life examples were really helping me. Now, the last part of this is hedging and derivatives. So the issue is when I was doing hedging and derivatives, I really thought they were different things, but derivatives is just the tool to achieve hedging. So hedging is the process of minimizing the risk of currency fluctuations. So currency fluctuations is, like I was saying, like maybe right now our dollar against UK is really bad, but then UK, something happens in a few months, their dollar goes up dramatically, and now like it cost me triple, 4 times, 5 times as much. That's at a risk, and that can really affect me. So to get over that, we use derivatives. So derivatives are the financial instruments that you use to lessen the risk, while hedging is just the process. So hedging is the process of minimizing the risk, and to act upon that process, you're going to use derivatives. So there's 3 different derivatives that you can use. You can use a forward exchange contract, which is a contract to exchange one currency for another currency at an agreed exchange rate on a future date. And that's usually 30, 90, or 100 days after. That's got that agreed exchange rate. So whether or not it changes, they've still got that set exchange rate, and it's agreed upon. So it's much safer in terms of being at risk of the fluctuating one. And this is where the bank's involved. So the bank is actually going to guarantee the exporter that within a set time, a fixed rate of exchange for the money generated from the sale of exports is going to be made. There's the options contract, which gives the buyer, who's the option holder, the right but not the obligation to buy or sell foreign currency at some time in the future, and it's protected from unfavorable exchange rate fluctuations because they've got that right, but it's still like an option. It's not actually an obligation to buy it. And then they've got the swap contract, which is an agreement to exchange currency in the spot market with an agreement to reverse the transaction in the future. So you can exchange the currency right now, but there is that spot sale that you can do to repurchase it at that same rate at a future date. So it's advantageous to businesses because they can alter their exposure to exchange fluctuations without discarding original transactions and then go back to old transactions where there was a better exchange rate currency. It's all just like swapping, and you're just deciding which agreement you're going to use on the spot market. But that is the end, guys. I hope you guys have a great holidays. I know that was a run-in. I'm so sorry. If you have not done finance yet, this was probably a little bit intimidating. But again, in this presentation, we went through the hardest topics. Again, a lot of that content was within an hour and a half, and you guys are going to get most of this term. And if you've already studied it, you've already had probably nearly a whole term to study finance. So this was very much just a summary. I really hope it helped you out. I hope that there's been questions in the live chat and we've been able to talk, and I can help you guys throughout. But otherwise, I wish you all the best in business studies. I hope that as you guys go throughout the year, you can implement some different study techniques, come back to these slides, use some of these notes, and that you guys had some good takeaways from here. I wish you so much luck. I think that business studies is such a game changer as long as you're studying the right way for it and you have a good mindset with it. Remember that scaling isn't necessarily bad for it as long as you're not falling into the average. And the fact that you guys are going out of your way to sign up for these 800 lectures, like I just know. I just know that none of us are falling into the average. All the best with your studies and with your other subjects too. But yeah, thanks for coming, guys.